Hey, this is John Starks. You be down here on the street and you watching Taking Stock.
We are counting you down to the close, everyone. It is Friday, July 31st. This is Taking Stock. I'm Kristen Scholler here on the floor of the New York Stock Exchange. A lot of news moving markets today. A mixed day on Wall Street, but big technology is back in the driver's seat. Amazon surging after a strong earnings report, while Microsoft adds to yesterday's massive double-digit rally, even as Apple slides on some weaker than expected services and China results. Well, investors are digesting a sharp rise in Treasury yields, with the 10-year climbing to its highest level since early last year as markets continue to reassess the central bank's path forward on interest rates. At the same time, here the biggest names in tech are showing no signs of slowing down their AI spend. We're going to break down today's market action with, of course, Einstein of Wall Street, Peter Tuchman, and catch up with the bell-ringing team from Conductor ETFs by Iron Horse. Plus, we'll bring you an interview with Reformation CEO Hallie Bornstein after she rang the opening bell earlier today to celebrate this company's IPO. Officially started trading yesterday under the ticker symbol REF. Time now for the bell, though. Conductor ETFs by Iron Horse doing the honors at the close, rounding out what is said to be a positive week on Wall Street. We'll give you a tale of the tape after the bell. So let's take a listen in as we are about to wrap this session of trade for this final week of July of 2026.
You can't see the board, so we'll just go straight to the interview. They sold them off really hard on that. We were up 60. Now we're up 45.
All right. That's going to do it for today's session. You saw them up there, Iron Horse, and let's take a look here at the tail of the tape. No one to better break down the week that was, and of course the session that was, than the Einstein of Wall Street, Peter Tuchman with Trade Moss.
Yes.
Peter, good to see you on this Friday.
Always a pleasure to be with you, my dear.
Yes, very much so. We're rounding out the month of July. What do you make of today's action, especially into the close?
You know what? I mean, I think it was fairly impressive. There was a lot of flow on both sides. The fact is, everyone needs to know that obviously the Fed day is a day where it gets very emotional. The initial reaction was on the upside, and then we had the market sell off aggressively after he stopped talking, and we thought it was probably a number of different things. It turned out it was that one hedge fund that
Yes.
that massive margin call that forced that to sell off.
Yep.
Now, the day after Fed day is the day that really you get the majority of the investment community gives its real impression of what the Fed meeting was about. There were the three dissenters, the most since 10 years has gone by, and they were all pushing for a raise in interest rates, and we did not get that. However, that day, the Thursday after the Fed date, you get the real impression of what the landscape feels like. And those days have been up ever since then. That's why we ended up having a closing week on the upside and it being sort of a bullish end to the week. So we were as high, I mean, we've been trading flatline off the high of the market all afternoon. And so it was impressive price action. I'm impressed with the way we ended the month. It was a wild month. Let's be clear, there were so many moving parts with memory, with the Mag 7, with the anticipation of earnings, with oil hitting 67.39, a pre-war low, and then bouncing back into the mid-90s and high 90s, and then pulling back again. We know that the long-term implications of higher oil are the inflationary, the implications in inflation. And so while that maintains a certain stickiness, we're trying to sort of get our footing back on what's going on relative to the war. We re-engaged the oil trade a little bit. And what's been curious is that while we've had oil down the last 3 days, transports as well have been down, and that's usually an inverse trade. So look, there's a lot going on here. You know, we've got, I think the overall view of what's been going on this week is CapEx versus monetization, right? We saw how much money was being put in. You mentioned it in your intro about the fact that the Mag 7 and a lot of those bigger names have continued to put their money into the AI trade. Those guys get a nice little bit of a lift today. Now the problem was why we had a couple of these weaker days earlier in the week was the fact that I mean, we saw that with Google. For the first time in history, Google had no cash flow in their account as part of their guidance report on earnings. That kind of gave the sense that their investors were being impatient. They weren't getting that return on investment that they were looking for. And so that sort of CapEx spending, which we know is going to take a little while to see its realization. And so people need to be patient with that trade, because we know the demand for AI is as big as it's ever been. We've talked to Dan Ives about it over the last couple of weeks. We did a piece on Wednesday. The demand is there, the spending is there, the monetization may take a little while to linger while it's trying to get its footing, but I think we're in good shape.
Anything to be watching over the weekend?
You know what, look, in this new world we live in, anything can happen in the weekend. Obviously, things out of the administration, I would think, relative to the war in the Middle East, how are the Straits of Hormuz, how's the oil coming out of there, the price of oil. I would hope that closing out the month, a month that has seen high highs and low lows, I would hope that everybody just takes a little bit of a breather, you know, and I would just step away. You know, I would enjoy the beginning of August. We still have some summer left to us.
Yes.
And, you know, and not really project. I would say manifest positivity and don't project into any negativity.
You mentioned the AI spend, and certainly we've seen some of these technology companies fare their own way. Very good results for Amazon, same is the case for Microsoft, underperformance for Apple. Do they all trade differently in this environment?
So I think what we've seen, which is unusual, is that the Mag 7 and the tech sector has broken down into multiple mini sectors inside, where we get a breakdown: software, chips, memory, compute, and that used to all fall under the big tech Mag 7 look. And now they're all individually, analyzed. And they all play a different role. And we've seen that a lot in the rotation trade that we saw all through July. Mm-hmm. When they're selling the software, they're buying the chips. When they're buying the chips, they're selling memory. You know, when they're selling memory, they're buying compute. And so there's been so much rotation, even in days where we've seen up 1,000, down 1,000, the advances versus declines have been 50-50. And that's something that I tend to analyze. Mainstream media tends to just sort of, catastrophize that story. But for me, that shows rotation. People are getting out of their under or overperformers and getting into value. We've seen a nice surge in mid-cap, small-cap, in the secondary and tertiary AI stocks. And so, I think we're in good shape.
All right. Peter Tuchman, of course, with
Always a
TradeMas.
pleasure.
Peter, always a pleasure. Thank you so much for joining us
Happy
here.
weekend, everybody. Happy trading.
Yeah, happy trading indeed. All right, everyone. Well, Peter mentioned some of these stocks that he's watching here, and I do want to focus in on a few stock standouts. Certainly Jersey Mike's, that's the ticker symbol JMKE. This company went public earlier this week. Today was its first full day of trading here on the NYSE, and take a look. This stock bouncing back after yesterday's IPO, shares up more than 3%, and the sandwich chain raised about $1 billion in its debut, valuing the company at more than $7 billion. Well, the franchise opens this next chapter with nearly 3,300 locations and counting, plans to expand internationally, and a goal of reaching 15,000 restaurants around the world over time. Next up, let's hone in on the Global X NYSE 100 ETF. This is ticker symbol NYSX. Peter mentioned some of these tech stocks that he's been following, and they make up the biggest holdings of the NYSX. That ETF up 1.1% in today's session, getting a boost as a top holding Amazon. Its shares surging more than a solid amount on strong earnings, and AWS cloud business growing about 37%. Its AI and custom chip businesses topping $25 billion in an annual revenue run rate, giving investors more confidence in this AI spend, as Peter was alluding to. All right, well, speaking of IPOs, earlier today I caught up with CEO of Reformation, Holly Bornstein, to discuss, of course, why now was the right time to debut here at the New York Stock Exchange. Let's take a look. The energy is palpable down here on the floor of the New York Stock Exchange, and I'm pleased to be joined by CEO of Reformation, Holly Bornstein. Holly, congratulations and welcome to the NYSE.
Thank you. It's amazing to be here. We are so honored. It's a huge day for Reformation.
Absolutely incredible. Walk me through the journey that got you to this moment today.
We have been hard at work just building a business that from day one really reinvented the way consumers feel about a brand. We modernized a brand in the fashion space. And so Over the last couple of months, we have been out there telling our story to a wide range of really impressive investors, many who are our shareholders today. And so it's been an incredible testament to all of the work our great team has done.
What does this moment mean to you on Reformation's journey?
Today is an amazing day. It's really a milestone, but importantly, it's only the first day in a long journey. We have big aspirations at Reformation, and we aim to be a multi-billion-dollar organization, a brand that truly redefines retail. So today is one step forward in that mission.
I want to hear more about what you attribute the company's success to. We saw the stock rise in its debut, and today's the first full trading day. Shares are up as well.
I love hearing that. We are a business that is truly predicated on amazing products and an unbelievable brand. So we have a brand that cuts through to our consumer with a really wide customer base. Both mom and daughter shop this brand. 20% of our new customers last year were under the age of 25, 20% were over the age of 50. So this is a brand that really attracts a wide audience and engenders incredible loyalty. We make great products. 84% of consumers say wearing Reformation makes them feel confident. And because of that, we know we have a real difference. And we also bring product to market in a super unique way. We can bring product to market as quickly as 60 days to really make sure we have the right product for the right time. So you put those two things together, brand and product, and it's a winning recipe.
I will tell you, I'm wearing a Reformation top. The color is lipstick, which I love, by the way. How have you seen the product evolve over time?
Well, we started as a brand that was definitely famous for dresses, but we've evolved to be a destination across categories, across occasions. And today we have businesses in denim, in sweaters, just like you're wearing, in shoes. And so we are really proud that 74% of our revenue comes from customers who are shopping across category. This is a business that can do a lot for our customers. She comes to us for the times that matter most, and we will continue to offer great products across all of those moments.
A woman-led business servicing female customers. What is your message to women watching today?
I think the real question is, why are more women leading companies like this? We sell products to women. I wear the clothing. I know how women think. And so my message is just keep thinking about who the end consumer is. And we all should be out there doing a lot more of this.
We've got a lot of fans here in the audience. Of course, at the New York Stock Exchange, we saw them around the bell. Yes, they're making some noise. Hallie for Reformation here today. All right. We love to see that. I'm sure it means a lot to you to have all of these people here today celebrating.
It's an incredible achievement. Yes.
Hallie Bornstein, CEO of Reformation. Hallie, thanks again.
Thank you.
Hi, Kristen.
All right, everyone, we've got a lot more here on Taking Stock. Joining me now to talk about this closing bell is Charles Cunningham. He's Chief Investment Officer of Conductor ETFs by Iron Horse. Of course, Iron Horse ringing the closing bell today here at the NYSE. It's great to see you, Charles. And what does it feel like to be down here on the floor of the NYSE?
It's great to see you. We've had a great time. It's always exciting. We've been here before, but it never gets old. So
the bell is
do this every Friday.
I think that we should. we do ring that bell every Friday, but you got to come back every Friday. Right. Indeed. Tell me where we stand right now from your vantage point in terms of the investing landscape.
So we primarily focus on international equities, value equities, more on the small cap side. And so from my perspective, we're very hopeful that there's a turn that's begun towards international equities away from the U.S. So last year, international equities outperformed the U.S. for the first time in a while. Mm-hmm. This year, you've seen international equities hold their own as well. So it's a great start. We're starting to see value act a little bit better. Mm-hmm. We're starting to see small cap act a little bit better, especially in the U.S. So you take it all into consideration. For many, many years, valuations become super stretched when you think about the U.S. versus international, when you think about value versus growth, when you think about small cap versus large cap. Maybe historically so, the first time we've seen markets like these and relative valuations like these in 25 years since the last tech bubble. So in that sense, things are starting to turn, and that's hopeful, but we think it's an incredible opportunity to jump in. We think when the cycle turns in favor of international equities and value and small cap, the cycle could last 8, 10, 12 years, just like it did in the 2000s. So we think it's a wonderful opportunity. We think we're on the bleeding edge of this, frankly.
Where do we stand now when we look at growth versus value on an international level?
Well, like the US, I mean, obviously everybody focuses on the AI trade or the IT trade, and that's been in place, and then going back to crypto, and then the Mag 7 trade, et cetera, for a while in the US. Well, the same dynamics are in play when you look at ex-US stocks too. So value is pretty historically undervalued relative to its growth counterpart internationally as well. So again, not too dissimilar to what happened 25 years ago. I'm a statistical geek, so when we think of things in terms of z-score, standard deviation, so when you look at value versus growth, you're talking about a market that's stretched the tune of close to 2 standard deviations in terms of relative valuation. So when you see things like that, it means the rubber bands are maybe close to breaking in our favor. And when that happened again 25 years ago, that kicked off a decade of significant outperformance in our space. And that whether you're looking at international only, whether you're looking at global, whether you're looking at US only. And so famously between 2000 and 2010 or so, the S&P 500 was down approximately 1.5% or 2% a year. The space that we operate in was up approximately 9% a year. So there was an incredible differential or delta between those performances.
What about small versus large caps?
The exact same dynamic. I'm like a broken record. So again, in the late 90s and going into the 2000s, those 3 vectors were all operating in a similar fashion, and they all kind of intersect in a certain way. So right now, along the 3 vectors we operate on, if you think international versus US, value versus growth, obviously, and small cap versus large cap, small cap might be more undervalued relative to large cap than the other vectors are. So in the case of small cap, you've started to see the Russell maybe act a little bit better here in the US. That momentum hasn't carried completely over to international yet, but you're talking about valuation differentials internationally between small cap and large cap that are as large as you've seen in the past 25 years.
What are you advising clients right now?
Come our way.
Stay the course? Is that the deal?
I would say, if we talk to people, and we're not really talking our book or talking our portfolio, but if we're being honest, we'd say it's a perfect time to shift portfolio resources or portfolio capital towards these sectors. More broadly, whether you're talking international or US, we would recommend equal weight index exposure, so to speak, over cap weight. Obviously, the markets are extremely concentrated. They're significantly concentrated in the US. So you think about the top 10 names in the S&P 500, for instance, comprising upwards of 30 or 35% plus of index exposure. So we think that's a little heady. That didn't end well for investors 25 years ago when the tech bubble finally burst. We think we're going to have a similar dynamic this time. So if you have more equal weight exposure, if you're tilting more towards small cap, whether you're talking about US or international, either way, in value versus growth. And again, that's just because the rubber bands are so stretched.
All right, Charles Cunningham, he's Chief Investment Officer of Conductor ETFs by Iron Horse. Charles, thank you.
Thank you very much. Happy weekend. Happy Friday.
Happy weekend, that's indeed.
Yeah,
Yes, very true. All right, everyone, well, don't go anywhere because we have much more Taking Stock just after this short break. Welcome back to Taking Stock, everyone. Earlier this week, FinTech TV lead anchor Remy Blair sat down with Dave Wright and Brian Solis of ServiceNow to discuss their new book, Infinite: How Visionary Leaders Transform Today's Companies into AI-Forward Businesses. Let's take a look.
Well, joining us this morning for a look at the playbook for the Infinite Enterprise are our co-authors, Brian Solis, Head of Global Innovation, and Dave Wright, Chief Innovation Officer at ServiceNow. Gentlemen, thank you so much for joining us this morning. So first, Brian, I do want to start out with you. Most enterprises are using AI out there, but there are many ways that they are doing this. So as someone who's studying macro shifts, why is using this technology to optimize yesterday's operating model a losing strategy against some of these AI native competitors?
Thank you, Remy. It's a pleasure to be on. As we were just watching in the news segments before the break, you see companies that are naming AI as they optimize yesterday to better perform for tomorrow, but that makes them a finite organization. As we see AI native competitors using AI at the very core of what it means to be an organization in 2026, 2027, and beyond. So what we believe, as we outlined in the book, is that to compete for the future, you have to reimagine what's possible with AI, not just what you could do yesterday better, more efficiently, less expensively moving forward, but what you could do tomorrow that you couldn't do yesterday.
Yeah, and David, I want to bring you into this conversation. And for viewers out there who might not be familiar with the Infinite organization, can you explain this to us? And given the fact that you argue that traditional org charts no longer explain how a company creates value, but workflows actually do, can you walk us through this?
Yeah, sure. So an infinite company isn't a company that grows forever. It's a company that can constantly reinvent itself and apply itself to new areas of business. So allow itself to develop, to adapt to markets, allow itself to be able to move into new areas. But it's not about reducing bottom line, it's about increasing top line. The interesting thing about most organizations is most organizations will have an organization chart they can show you, but an org chart just shows you who reports to whom. A work chart is designed to show you how value actually flows through an organization. And because we've organized around functions for hundreds of years, AI forces us to organize around flows. So it ends up not being a technology change, but this is a fundamental design of how companies think about themselves when they're not forced to be constrained by the fact they have a limited workforce, but they now have to think about how they arrange around infinite intelligence.
Yeah, and I do want to mention the fact that we are in the thick of earnings season, and of course we've been paying attention to the results, in particular CapEx, when it comes to the hyperscalers. And Brian, surging AI investment has left many C-suites frustrated by a lack of measurable cost savings, ROI, and especially for some investors out there. But why does traditional financial ROI fail to measure transformation when it comes to artificial intelligence? And how do you calculate a true return on intelligence?
Well, we always ask, if you're going to reduce someone's time or increase productivity, what do you want to do with those savings? And oftentimes that's where the conversation stops. We introduce in the book a concept of what we call ROI, return on intelligence, where we look at all of the cost factors that are affecting your organization. But more so, we ask some really deep questions, and we also have the answers. I don't want to just leave you with questions, but what do you want to do differently moving forward? If you're going to take time away from someone, what could you do with that time in order to add net new value? So it's beyond automation. Now we're looking at augmentation. How can humans and AI work together to produce greater outcomes that were just not possible before? And I think that's where CEOs get frustrated, because they're limiting AI to cost takeout, not to growth.
Yeah, and I do want to expand on that, especially given the fact that headlines are dominated by fears of AI-driven restructuring, as well as concerns about headcount reduction. But as you mentioned, as enterprises deploy agentic AI, David, how do leaders design a human agent operating model that can amplify human judgment rather than creating concerns, especially when it comes to workforce resistance?
So I think this is one of the problems. I think the fear is completely rational, but it's aimed at the wrong target. The The real problem here isn't AI taking jobs. It's that your organization, as Brian said, only uses AI to cut costs rather than create new value. So for me, leadership need to be very transparent in what they're doing. But we always say that when it comes down to AI, your AI strategy should not be about AI. Your AI strategy should be about achieving something else from a business perspective. And then you think about how you use AI to free up the time and resources to allow you to achieve that business objective.
But we will have to leave it there for today. But thank you so much for joining us this morning. And thank you so much for sharing your perspective as well as your insights.
No, thank you.
Welcome back. This is Scarlett Sieber with Money 2020. And on this segment of how fintech companies actually make money, we're going to be talking about ClearJunction, a company that lives exactly where most fintechs, they don't want to live. ClearJunction provides cross-border clearing, accounts, and settlement infrastructure, often for regulated institutions, crypto firms, and payment companies. So how does ClearJunction actually make that money? First, transaction fees on transfers and settlements. Second, account infrastructure fees for regulated access across jurisdictions. Third, FX spreads when money crosses borders. What most people underestimate is the moat. ClearJunction operates where compliance is expensive, slow, and unforgiving. That friction scares competitors away, and it protects those margins. So why now? In the last few weeks, ClearJunction has become a visible bridge between traditional banking rails and stablecoin issuance, putting it directly in the flow of regulated digital money. ClearJunction doesn't just monetize innovation, it monetizes permission. And that is how ClearJunction actually makes money, by sitting exactly where regulated money has to pass through. Drop the next fintech you want unpacked below, it just might make the cut. In the meantime, back over to you.
All right, everyone, thanks so much for watching today. That's going to do it for Friday's show. And of course, the week. We'll be back here next week to start August. I'm with you on Monday afternoon, and Ashley Masternardi has you covered, of course, on NYSE Live early on Monday morning, 9 a.m. sharp. We'll see you then.